Hi, this is P.R. Sundar. Welcome to this special episode where I'm going to show you a strategy which is actually not for retail people, for HNI clients. Right? So I met a lot of HNI clients, and most of the HNI clients are risk averse people. So they do not want to take risk. Somebody who has having 100 crore, why does he want to take a risk? If you put the money in bank FD also, he will get 7 crore, 8 crore interest, right? Which is risk free. So most of the people, when they meet me, they ask me one question, sir, is there any risk free strategy in the stock market? Here, there is a risk. For that risk only, we are getting the reward. If you want risk free strategy, yes, there are risk free strategies. But your return is not going to be very high. You may get slightly better than the bank FD rate. Right? So today I'm going to discuss one such strategy with 0% risk. Means you don't have the risk at all, but you can make some money. Right? First thing is that okay, you have to buy a Nifty bees. I'm just giving an example. 100 Nifty bees is equal to 1 Nifty. One lot size in futures and options is 75. So you have to buy 7,500 Nifty bees so that you will have Nifty bees is equal to one lot of Nifty. Right now, Nifty is trading around 24,600. So if it is 24,600 divided by 100 should be 246. But the Nifty bees will not be trading at 246. It may be trading around 280. Well, about 40-45 point premium. But that is nothing to worry because, when you are buying, you pay 40-45 rupees higher. I'm sure when you sell also, you will be selling at 40-45 rupees higher. So that premium is always there. That's because, they don't distribute the dividend. So the dividend is added into the scheme. Or I heard that there is some SBI Nifty Bees, which, where the dividend they distribute it. So it is not added. So that may be trading around 246. So I'm just checking with the Nippon India Nifty Bees. Okay. So for all practical purposes, we take it as if you are buying at 246. Means like you are buying a Nifty 24,600 Nifty Bees. So into 75, that will cost around 20 lakh rupees. Okay. So once you have bought it, now if market goes higher, you will make profit. Market goes lower, you will lose the money. Market goes higher, you will make profit, but market goes down, you will lose the money. So you do not want to take risk. So you have to do the hedging through futures and options. So maybe I will show you from the computer. Okay. So this is the Nifty option chain. And this is a Nifty. Expiry is 29th December 2026. So that's roughly about 1 year, 5 months away. So here what you need to do, 25,000 put option is trading around 950. Okay. There's one challenge. There may be a slight liquidity problem. Okay. But assuming that you are buying this, so you are paying 950 rupees from your pocket. Now, you don't want to pay this money from your pocket because you already paid 20 lakh rupees for buying the Nifty base. You don't want to pay this money. What you do, you just go and sell 28,000 call. Also trading around 950 rupees. So you buy for 950, sell for 950. That means you don't receive the money, but you are not paying any money also. So now what happens, no matter how much market goes down from here, you do not have to lose even 1 rupee because you have a buy option, 25,000 put option buy. So if the market goes down, you will lose money in Nifty Bees, but you will gain money in 25,000 PE buy option. And also you will make some money in selling 28,000 call option. Sometimes if the markets react violently, the loss in the Nifty Bees may not be compensated by those two profits, but it will compensate more or less. There might be some temporary MTM loss. So along the way, I will tell you the challenges also. The first challenge, there may be liquidity problem when you are dealing with very, very long-term option. That's one challenge. Second challenge, if markets move violently, the profit in the options may not compensate the loss in the Nifty Bees, but that's only a temporary phenomena. You just, because Nifty Bees, you bought it in cash market, there is no question of MTM also, right? You don't need to pay any money. But theoretically speaking, if you want to exit at that point of time, you may lose some money, but you should not exit. You have to hold it until next year, December. So that's the second thing. And then slowly, by the end of next year, December, assume that market crashed. Let us say market go and close around 20,000. So somebody who buy at 24,600, if it goes and close at 20,000, they will lose 4,600 rupees. But you have nothing to lose. In fact, you will gain something. I'll tell you what you will gain. You bought at 24,600, and let us say if market go to 20,000, you will lose 4,600 rupees in your Nifty Bees. But the 25,000 put option, you will get a profit of 5,000 rupees. You will actually gain 400 rupees. But 400 rupees is nothing. Like 400 rupees is just only 1.5% return for your investment. You put 20 lakh rupees. If you put the money in bank FD itself, you would have got 1.5 lakh rupees profit. Okay. But this 400 rupees is also good, right? The 400 rupees per share. So that will translate into how much? 75 into 400. So that's a decent money. That's a decent return for your investment, right? We are talking when the market is like crashing down like anything. Even then, you don't lose, you gain a little bit. But on the other hand, let us say market close anywhere between 25,000 and 28,000. 25,000 to 28,000. You will make profit in the Nifty Bees. Of course, you will lose some money in the buying of put option, but that money you did not pay from your pocket. You sold 28,000 call. That will also go to zero. This will also go to zero. So in options market, your net profit or loss will be zero. But you make some money when the market goes higher. Assume that market goes beyond 28,000. Let us say market go to 30,000. What will happen? Put option will go to zero. Call option 28,000. Beyond 28,000, whatever you are getting profit Nifty Bees, that you have to pass it on to the 28,000 call buyer. So which means that you are restricting your profit only to 28,000. So you bought at 24,600. Your profit ends at 28,000. So that means about 3,400 points you are making profit. So 3,400 point profit will translate into about 13-14% profit. Like 1 year, 5 months, 13-14% profit, that gives a slightly better return than the FD return. So here is a strategy. Buy Nifty Bees, then buy a put option 25,000 PE and sell call option 28,000 CE, both next year December options, and then you are completely protected on the downside. No matter how much market goes down, you will not lose even a single rupee, but you will, on the contrary, you will make some small profit. But if the market goes higher, you tend to make some better profit. But then again, sir, what is the big deal? You put 20 lakh rupees on the table, right? So you are making, 3,500. That is the maximum profit, 3,400. Okay. So like that will be about, like 14-15% profit only. So that will be slightly better than the FD return, right? Okay. But there are many other aspects to this. Number one, normally people do this when the market fall, let us say 10%. So first I'll give you another analogy. The people will say market has already fallen so much. Now you buy, market will go higher. Then you go and buy. What happens? Market fall another 5%. It's easy for the people to say you go and buy an average. The one you bought, you are already sitting with a 5% loss. Where the psychology will work to buy some more. The next question will come, if the market continue to go down, okay, let us say you buy at 100 rupees, now come to 95 rupees, again you buy. Again, if the market go to 90 rupees, what you bought at 100 rupees is also giving loss. What you bought at 95 rupees is also giving loss. The people will say to go and buy and average at 90 rupees. Then, if the market goes to 85 rupees, what will you do? So that fear will always be there. Already your existing positions is sitting with a huge loss, and you keep on buying more and more. You should have a conviction that market will definitely go back to 100. Otherwise, psychologically, it's going to be very, very draining. But come back to my model. You buy the Nifty base and the market is down 10%. If the market go up by 10%, you make a very good profit. Let us say market come down another 5%. It's simple. Your existing position is not going to give any loss, but your existing position is completely protected. It's a zero loss. So if the Nifty comes down by another 5%, you can do one more setup because your existing position is not in loss. So therefore, you will dare to do this one again, buy and average. Say for example, Nifty went to 26,300 last year, then started correcting. So let us say about 1,300 point fall. At 25,000, somebody has done this. Now the market has fallen. He has nothing to lose. So again, when the market come to 24,000, he should do again. Again, market come to 23,000, he do again. Again, market come to 22,000. See, in the real life, the one who is without hedging, 25,000 loss, 24,000 loss, 23,000 loss, how he will have a conviction to buy 22,000. But in our case, 25,000, no loss, 24,000, no loss, 23,000, no loss, 22,000, he will dare to buy. But again, one may ask a question, sir, where the people will have so much money, keep on averaging, every time we have to pump in, right? But normally what happens, people who have money, 100 rupees, they put it in debt mutual funds. So when the market fall 10%, the 20% of that debt fund, they close it, they move it to this strategy. And after that, every 5%, so the 20% of the debt fund, they move. So that means to exhaust all the 100% debt fund money, so Nifty has to fall 30%. And Nifty has not fallen 30% in the last 25 years. It has fallen only 2 times. Coronavirus and Lehman Brothers collapse. And both the time, the market shot up more than 100% during the next 1 year. So what happens, 30% fall, then you just leave it. Then if the market continue to fall, nothing to worry because you are not going to lose even 1 rupee. But if the market reverses, what will happen? The first strategy will give maximum profit. Maybe second strategy will also give maximum profit. Maybe third and fourth may not give the maximum profit. And overall, you will get a good profit. But then again, as a strategy, this strategy is good? I would say no. Why as a strategy is not good? See, on one side you want zero risk. With the zero risk, anybody can make 20%, 25% return. If that is the case, everybody will be doing this. Nobody will be doing any other work in India. We go and look at the top 50 companies' balance sheet. They work so much. They manage thousands of people. They manage such an empire. But at the end of the day, they don't make 40%, 50% profit. They make only, they must be happy if they make 15, 20% profit. And here you will get 10, 12% profit without doing anything for a whole year with a complete protection. Even the companies, they don't have the complete protection. And one tsunami can come or one earthquake can come, their factories can be destroyed. Of course, you can say, sir, we have paid the insurance, we will get insurance money, but where the insurance will pay the full money? It's not going to compensate. Even if the insurance pay the money to reconstruct that factory, how long it will take? So then you lose the opportunity cost. But here you don't have anything. But however, what is good in this strategy, why people do this strategy, they buy the Nifty base and they pledge it. And they get I think there is about 6% or 10% haircut. After the haircut, they give the trading limit. With that trading limit, so the people, they do the trading also. So trading, they make some money. Say, for example, normally what the big traders, they do, they put their money in debt mutual fund, they pledge it with the exchange, and then based on that, they get the limit, they do the trade. So what some ultra HNI clients, they do, same thing only they do. Their main source of income is trading. It's not this debt mutual fund. But still, debt mutual funds give 7-8% return. One of the debt mutual funds I've been investing for the last 1 year, it has given more than 10% return. That's because, the like interest rates is going down in the economy. When the interest rate goes down in the economy, debt funds tend to give higher return. But normally it will give equivalent to FD return only. But the point here is that is not their main income. Their main income is trading. So this is a secondary income. So the same way, the people who buy the Nifty Bees and they pledge it, they do the trading. So there the main trading income coming. But here they get good profits, if the markets do well. And also they don't buy at the peak. They buy when the market falls 10-15%. Then for every another 5%, they keep averaging. So Indian stock market history shows no matter how much market fell, uniformly next 1 year, 2 year, markets have recovered. So that is the logic. Of course, there are some negative things. If the same thing if you were to do in US, since you have the Nifty Bees, they don't charge any margin money for selling call option. But in India, it's not like that. In India, you have to pay the margin money. That margin money may be around 10% of your capital. Say, for example, if you have 100 rupees, put it in Nifty Bees, there's already 10% haircut. You can use only 90%. Out of that 90%, another 10% you have to pay the margin money for doing this hedging. And then only the remaining 80% you can use it for your trading. So SEBI is doing a lot of changes. SEBI should seriously look into bringing this. Somebody is holding in the demat account. If they're selling a call option, the margin money should be zero because they have a zero risk. When there is a zero risk, why should they pay 2.5 lakh rupees margin money? And moreover, they are doing to hedge their portfolio, right? So the job of the regulator is to, curb the speculation, not the hedging. But here somebody is doing the hedging. No, it is not allowed in India. But whereas that is the standard norm in the entire world. So we always behave differently, right? So that is one challenge. So number one, you have to pay margin money. If you pledge it, you can get the limit, you can use that, but then your trading limit goes down. So that's one challenge. So a lot of challenges are there. And moreover, there's a rule in SEBI that if you are dealing with options which are expiring more than 9 months away, then there is, it is considered to be highly speculative. So therefore, there's some extra margin money. But here the person is not doing any speculation. He's just hedging his portfolio. At least that extra margin money should be removed. Now the people say, weekly options are the speculative, not the long term. But then why there's extra margin money for long term options? So, the problem in India is that, actually nobody knows what they are doing. And whoever, somebody is being advised, and they just listen to them and they just carry out the rules. There's no logic in that. So all that, if they do it, so this kind of trading must be encouraged. Okay. People taking the cash market position and hedging through long-term options. So, that if you want to encourage them, you have to give incentive. You don't need to give incentive, but don't give extra punishment. Right? So just like Trump, 25% tariff plus punishment tariff for buying crude oil from Russia. Like that, here you pay all over the world, the standard norm is span margin. There is no such thing called exposure margin. So already in India, we have span margin plus punishment margin. That's called exposure margin. Then if you are dealing with the long-term option, you pay span margin plus you pay punishment margin, that is exposure margin, plus you pay additional penalty, additional punishment margin. That's called extra exposure margin. So, all this makes, because, the people who want to take the least risk, they want to take least profit, they should not be disturbed, when they pay so many punishment margins, the returns go down. So naturally, nobody will be interested in coming into this kind of trade setup. So these are all the things the SEBI should look into it. We cannot do anything. But today, I have thrown a strategy suitable for ultra HNIs, and they make a decent profit with zero risk. But then, sir, I'm not happy with this return. Can I increase the return? Okay, so that is beyond the scope of this YouTube video, but we teach everything, then people will not come to attend our workshop. So we teach all those things, how to maximize the return, how to minimize the risk. Now, let us say if the market shoots up 30%, I want to gain the entire 30%. All that we teach in our workshop. So if you are interested, you may contact our office. As and when we conduct the next workshop, we will inform you. So hope you enjoyed watching this video. Thank you for watching.